My next guest is changing his market outlook after the huge rally in stocks following the Fed pivot last week. He says small and mid-cap value are no longer the table-pounding fat pitch buy they were in October. Joining me now is Charlie Bobrinskoy, Vice Chair and Head of the Investment Group at Ariel. And correct me if I'm wrong, Charlie. I don't even know what to say.
Well, what you should say is what important economists have always said, which is when the facts change, you need to change your outlook. And that is what has happened. We have gone from, I want to be careful here, table pounding fat pitch buy, which is what small cap value stocks were, to approximately fairly valued right now. And that's not the end of the world. That doesn't mean bubble. That doesn't mean overpriced. That doesn't mean sell all your stocks. It means that our expectation is that returns from here will be normal, which for small cap value is kind of 10%, not bad, but that we are no longer ridiculously cheap. And we were ridiculously cheap in October.
So what does that walk us through tactically what you're doing now as a result?
So first of all, we don't think it's smart to trade tactically and to come in and out of markets. When people do that, they tend to come in at the wrong time. They tend to buy when everyone's happy and bullish, and then they tend to sell when markets are down. So that's the wrong thing to do. But what you should do is look at valuation. And when we look at our calculation of the intrinsic value of our portfolio, that was a 36% discount in October of this year. 36%, our stocks were trading for 36% less than what we thought they were worth. Today, that's about 23%. It's not terrible, but it's about average historically. So, the endowment effect says that we probably like our stocks that we own, maybe even more than we should. So let's say that that's about an average discount to intrinsic value. That means now is not the time to do anything dramatic, but it's not the table-pounding buy time that it was 4 months ago.
Yeah, I'm trying to think of what, so it almost sounds like what you're saying as a result, Charlie, is that you're just kind of sitting tight. We're showing some of the companies you've liked historically, Mohawk, Goldman, Bank of Oklahoma. So are you sitting tight here then and just kind of waiting this out? You're not, going long the Mag 7 or something like that?
No, that would be really bad. No, that we do not think you should do. That is the one, I'm glad you brought that up. The one area that is still overpriced, maybe even bubble priced, would be large cap tech. We are worried about the Magnificent Seven, who have underperformed this last month. Just 1 month doesn't make a long-term trend, but those stocks are seriously overpriced, and they, as you know, have a huge impact on the S&P 500. So we would say, I would personally be modestly bearish on the S&P 500 and call me fairly priced for small cap and mid cap value.
Which kind of goes back to the questions about the Russell 2000 versus the S&P and a few things like that. Again, I know you're not a big fan of kind of investing more in the indexes broadly, but you do think that headwinds for the Magnificent Seven will keep the S&P from shining more brightly from here on out?
That's exactly right. People have been hiding in the Magnificent Seven. If you thought a recession was coming, you avoided cyclical stocks, you avoided cyclical sectors, you avoided banks, you avoided oil, you avoided consumer discretionary, and you bought things that you thought would do fine no matter what the economic outlook. Amazon, Microsoft, Apple, those names tend to do fine in any economy, and so people have been hiding in the Magnificent Seven. And I think that trade is going to unwind as people realize we are probably not going to have the recession that the bond market has been telling us was a certainty for the last 18 months.